It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Are we sure about this recovery? From a looming natural gas shortage to slowing Chinese growth to indecision in Washington, you have to start wondering. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on inflation, bond yields, and whether it's all just a blip.
Markets are substantially underestimating what's likely to happen to interest rates before too long.
And what Evergrande could mean for the Chinese economic growth engine and U.S. investors. Investors had their fair share to worry about this week, starting with a dramatic spike in natural gas prices in Europe, putting at risk heat in homes and power in China. Here's Jeff Curry, Goldman Sachs Global Head of Commodity Research.
This is just the first inning of a multi-year, potentially decade-long commodity supercycle,
which only fed the concerns already out there about inflation. Here's Republican Congressman French Hill of Arkansas.
We have addiction to spending in this city. We've had since 1789, but it's on steroids right now, and it's creating inflationary expectations that I think could concern every retired person and every low-income person, because inflation is a thief.
And when we talk inflation, concerns about the Fed tapering its bond purchases cannot be far behind, something Fed Chair Jay Powell put in play last week.
So long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate.
And did nothing to back off of during his testimony this week before the Senate Banking Committee.
Mainly what we've seen is that the supply side restrictions that are so much at the heart of the inflation we're seeing have not only not gotten better, they've actually, in some cases, gotten worse.
But then again, Senator Warren said that if she had her way, it wouldn't be Mr. Powell making the decisions anyway.
Over and over, you have acted to make our banking system less safe, and that makes you a dangerous man.
And if all that weren't enough to set markets off this week, we had the continuing specter of the United States possibly defaulting on its debt as Republicans and Democrats continued to bicker over the debt ceiling, with each side blaming the other. Here's Senators Pat Toomey and Sherrod Brown.
The Democrats have chosen to ignore our warnings about this excessive spending, but they want us to vote to raise the debt ceiling in order to permit the massive spending increases that they're planning.
Senator Kennedy, I rarely speak between witnesses, but I wonder if Secretary Yellen takes you up on the offer to go get a cocktail, if you would pay or you'd skip out on paying the bill and expect Secretary Yellen to pay.
And the markets? Well, it could have been worse. After taking a hit on Tuesday, equities gained some of it back, with the S&P closing the week down just over 2%, while the Nasdaq took the biggest hit, down over 3% for the week. While the 10-year yield, after jumping up on Tuesday, settled down a bit to end the week just under the 1.5 level. While Bitcoin put on a late week surge, closing over 48,000. To help us make some sort of sense out of these markets this week, welcome now Peter Krause. He's chairman and CEO of Aperture Investors. Welcome back. It's great to have you back on Wall Street Week, Peter. So give us a sense of what you think happened this week. Was it all about the 10-year yield?
I think your opening remarks were terrific, but I would say the following. There's a lot of noise out there, so let's focus on the facts. The facts are the Fed has clearly said they're going to taper. The facts are the Fed has said, I'm not going to increase interest rates until well into 22, early 23. Facts are we continue to have growth. Facts are we continue to have elevated inflation, not runaway inflation. So in that sense, it's transitory, but certainly more inflation than we had at 1.5 to 2%. So if you have growth, you have inflation, you have the Fed saying they're going to taper, you have the Fed saying they're not going to increase interest rates, it seems pretty clear to me that long-term rates have to start rising, and they have been. Well, certainly on top of that, the energy prices are reacting, and we have growth. We're not at the point of a recession. So I think if you take away all the noise, it's actually reasonably clear.
Well, but reasonably clear as a good market to invest in, as a questionable market? Because it seems like if you take this week and last week put together, both weeks, for different reasons, we had big sell-offs in equities and then they come back again. It seems to be very choppy, as they say.
Yeah, I think the equity market, at the level that it's at, is clearly at a value that is getting a little bit high. And I think the equity market's behaving that way. Now, I don't think we're going to see a recession, so I don't think we're going to see a significant pullback. But I've said for the last 6 months to 8 months, this equity market could certainly see a retrenchment of 10 to 15, perhaps even 20% as it reprices itself. The Fed activity over the last number of years has clearly driven interest rates to very low levels. We know real rates in the United States are negative. Real rates in Europe are negative. So what does that mean? That means that all the cash that might have been running after fixed income markets went in the equity markets. So clearly the capital allocation is not normal, and people have more invested in the equity markets than traditionally, and they've driven prices to high levels. So do we have volatility when rates start to move? Absolutely. Would you put cash in the equity market today? You'd probably wait to see for the volatility to reside.
So the question is, if low rates really drive this so much, that does depend critically, does it not, on Jay Powell's statement, this is transitory, it's not permanent. Even this week when he was giving testimony up on the Hill, he said, it's worse than we thought it was and it's more durable. And every time he talks, there's another reason. It was used cars, and now it's natural gas prices. There's always something else. And those supply chain problems are going to linger for a while, aren't they, Peter?
Yeah, I do think they will. I don't like the word transitory because it suggests that the level of inflation that's currently there is going to recede to the level of inflation we had before rates or inflation became, quote unquote, higher. I don't think that's the case. And I actually don't think that's what Powell means. What I think he means is that 4%, 5% inflation is transitory, but not necessarily 2 or 2.5% is transitory. And if we had 2 and 2.5% inflation that was normal and stable, we would definitely have higher rates and capital allocation would take place. And I suspect the equity market would have to reprice that. Look, the Fed is in a tough spot. They've gone from $4 trillion in a balance sheet after 2008 to an $8 trillion balance sheet trying to support the economy during COVID. They don't really have a lot of options if they're going to take the balance sheet down. They have to say they're going to taper. That's the only way the balance sheet can come down. They don't want to raise rates now because that could actually hurt the economy's growth. So they've said they're going to raise rates in the future. So I think that's the story. That's where we're going. And the equity market's going to have to adjust to that reality.
Peter, we spent an awful lot of time covering what's going on in Washington, which doesn't make it right. Maybe we're wrong in our judgment about how important it is. But what if the market's priced in, for example, with respect to infrastructure and with respect to this budget, which is $3.5 trillion or maybe $1.5 trillion, if you listen to Joe Manchin this week?
I think the market hasn't priced in any particular action in Washington other than perhaps the bipartisan infrastructure bill. I don't think the market is priced in a debt default. I don't think the market believes a debt default is going to actually occur. If a debt default occurs, that would be a serious consequence.
So when you're looking to put cash to work, you said it might not make a lot of sense in equities right now. Where do you put it?
And if you actually have cash and you want to deploy it, I think the question is going to be, what's the long-term objective? If you're putting it somewhere for a short period of time, you should buy short duration securities because they're liquid, they're not going to move that much, and you'll get a better idea of what to do. If you're investing for the next 3 to 5 years, equities is still a good bet. Equities 3 to 5 years from now are going to be higher, and they're going to be higher than whatever you put your money in a bond.
So, Peter, you're such an astute observer of the markets. What is being mispriced by the markets right now, in your judgment?
Well, I think, your lead-in, Larry Summers said that, in fact, the markets are going to be a lot higher. Bond markets are going to be a lot higher over time. And I think that investors have gotten used to a Fed who's willing to actually come into the market to stabilize the equity markets and drive real rates to negative levels. And so that's been going on for a period of years. And as a result of that, investors have reacted to it. They've said, I don't want to own bonds, or if I'm going to own bonds, I'm going to own high yield bonds, or I'm going to own long duration bonds. So you have a market that has more money than probably it would normally in long duration securities and high yield securities and in equities. And when you go back to normality, that's going to have an effect. And that's what I mean by capital has been misallocated. because we don't have a normal Fed. This is not a normal time period.
It certainly doesn't feel like a normal one. Thank you so much, Peter Krause. He's going to be staying with us as we take a closer look at inflation and how investors might cope if, in fact, it's here to stay, contrary to what Jay Powell claims. That's next. This is Wall Street Week on Bloomberg.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you?
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
This is Bloomberg Wall Street Week. I'm David Weston. There was more talk of inflation this week, with Fed Chair Powell admitting it's a bit worse and more persistent than he'd expected, but still not really something to worry about. And natural gas prices really shot through the roof over in Europe because they have some problems with some supply chains. What if Chair Powell is wrong and real inflation is here to stay after all? What should an investor do? Still with us is Peter Krause of Aperture Investments, and now joining us is Nancy Davis of Quadratic Capital. She is the CIO and founder of that organization. So, Nancy, let's start with you, because you've made something of a name for yourself when I say that in the area of inflation. Without regard to whether you think it really is persistent or not, if it were to be persistent, what should an investor do?
I think every investor needs to be concerned about inflation, especially retirees, because you're not going to benefit from the wage inflation if you're not in the labor force anymore. So we do live in a real world, and inflation is a risk to every investor portfolio because it reduces purchasing power. I think investors just shouldn't be taking a bet on whether it's transitory or not, and really should have, as part of a diversified portfolio, should own some amount of inflation protection.
Well, just to follow up on that, Nancy, what does inflation protection look like? Is that gold? Is that real estate? What is that?
Well, I definitely have a different view about what inflation protection is. I know a lot of investors look at commodities because that worked in the 70s in the last period of hyperinflation. But I think commodities are like the laptop, I'm talking with you on tonight. It's deflationary. Technology has innovated in that space. So I just don't think commodities are the only way to think about how to capture inflation. I personally like using the difference between short and long dated rates as another measure of inflation expectations outside the consumer price index. I think that's a thing that investors have to keep in mind, is that's just one index. It's like if you were to buy equities, nobody would buy just the Dow Jones index and say, oh, I have all equities. I think investors have to be diversified.
Peter, same question to you. If you
I think Nancy makes a really good point about that. First of all, in the commodity inflation time period, we didn't have the same kind of technology boom that we see today. And we didn't have anywhere near these social, I shouldn't say social, but ecologically beneficial ways to actually produce energy. And Nancy's business has really focused on a long-term structural benefit that's out there of taking advantage of the difference between short and long-term rates. And she's made it liquid. And I think that if you want to buy inflation protection, that's a part of your portfolio that you could easily tailor, own, and it would give you protection to do that. You could also own commodities, but you are susceptible to supply and demand changes, political changes, technology changes. So there's more going on in the commodity world than there is in the sort of pure rate opportunity.
So, Peter, let me just pick up on something you referred to, which is what's going on with climate change and some of the things that are being done by the Biden administration and others in response to that. Gillian Tell of the Financial Times this week wrote a column in which she called it greenflation, because she said, as we make this transition, it's a massive transition away from greenhouse gases. It's got to drive some prices up. There's got to be inflation. Is she right?
I think she's right. I definitely think she's right. And I think it's a little bit difficult to calculate. So what I mean by that is, we're all going to move towards a green world. That's a good objective, and we should go there. But what we don't know is how long is it going to take us collectively as a global economy to actually get to the point where the green world is efficient, cost-effective, and actually produces enough energy for us to operate our world in. And that time period, we don't know. And if we haven't invested enough in carbon fuels to actually have the supply to get us there, we're going to see price spikes. And we're going to see them actually be very rapid and actually quite disconcerting, because you're not going to be able to increase the supply fast enough to be able to deal with the shortfall.
One of the things, Nancy, clearly we have not invested enough in is supply chains all around the world. I mean, it started with semiconductors, but it's gone well beyond that. Take a look at all the ships lined up outside of Los Angeles and even here in New York. What about that as an effect on inflation? Is that going away anytime soon?
Well, it's really a result of the supply shocks around the world. It hopefully will go away soon, but we're also having labor shocks at the same time. So goods and services are not being able to be shipped around the world. Factories are not working at full capacity. And it's a bit of a catch-22 because, something's got to give eventually, and eventually the demand will be met. The question is whether we're going to have higher costs without the earnings per share growth that has been priced into corporate America. If you look at stocks and corporate credit, the markets are really expecting a lot of growth. And when you listen to some of the companies as they report earnings this season, a lot of people are talking about the labor market and the delays and the higher costs that are not necessarily growthy costs. They're more potentially a stagflationary costs, or we have higher costs but not the earnings per share growth.
Peter, as I listen to Nancy, a lot of what she describes is the direct result, I suspect, of the pandemic. We had to shut down the economy and then bring it back up. But is it really the cause of what we're seeing, or did the pandemic reveal some underlying structural weaknesses we had, perhaps around the supply chain, having too much devoted to certain countries, like, for example, China? Is it really revealing more structural issues for the economy that have to be addressed?
Well, that's an interesting question. I think you could argue that there was nothing structurally wrong with the supply chain, although it was clearly concentrated in certain areas. I mean, remember the nuclear disaster in Japan, and automobile manufacturers realized that their supply constraints were disrupted dramatically because they were getting a lot of supplies out of Japan in a specific place that was near Fukushima. So natural events do have an effect on supply chain, and COVID had the same effect, although on a global basis. And so, now we're trying to figure out how do we diversify the supply chain so that effect doesn't happen as often. But we're always going to have some aggregation of supply, because ultimately there's a benefit of suppliers being near each other. They use the same kind of labor costs, use the same kind of energy costs. And if those costs are low and attractive, you're going to attract a number of people that produce goods that have an ecosystem around them. So I suspect that you're always going to have these kinds of shocks in the supply chain when you have natural events that are catastrophic. So in that sense, I don't think that COVID exposed a weakness. It exposed kind of the persistent issue you have when you've got a global supply, structure, and effectively there's a concentration in the system somewhere.
And Nancy, finally, we have a supply shock in the sense, as you point out, in the labor market right now. And that may be just we're trying to get people back online. They're still concerned about COVID. Or there could be a more fundamental shift now that's happened because there was the disruption. It's caused people to rethink what they're doing with their lives. As an investor, do I need to have a view on that subject, whether we have a longer-term disruption in the labor market? Or can I invest in a way that I'm protected either way?
Well, I think most investors, when they look at their fixed income portfolio, especially with a lot of people have decided to retire and leave the labor force, that's where inflation, you really don't want to be taking a bet that we're not going to have higher inflation. You want to have diversified fixed income exposure. And many of the indices out there that are core fixed income do not have inflation protection inside of them. And that's because they were older indices that were created before the Treasury started the inflation-protected bond market. So I would just say to investors, know what you own, try to be diversified, add lots of things to the portfolio to achieve that diversification. And I think inflation protection is just one of those things that you should have now, especially with the fiscal spending that's happening and the labor market shortages.
And Peter, sort of the same question to you. Are we seeing a longer-term shift in the labor market? A lot of people can't explain what's going on right now.
I think that the labor markets are probably not as flexible as they had been in terms of people moving from state to state in this country. I think that the low-cost labor that was available in developing markets has changed a bit. It's now higher. So that not as much labor supply is moving around the world. So I think those things are definitely in place. And I also think that we've had a long period of time of deflation in wage costs due to one, low wage areas that were manufacturing products. And as Nancy mentioned earlier, technology that drove costs down. I think technology is probably still going to provide a declining cost curve in the future for labor. And so that I think is still going to be a benefit. But I also think the cost of labor and the cost of high-end labor is going to continue to rise, and there is inflation. And so the sort of deflation benefit that we had in wage cost plus the technology benefit, that's what's going to change. And I think that will lead to margin pressure on companies. They're going to have to grow their top line and drive their pricing in order to keep their margins.
Yeah, it's fascinating. Really interesting discussion about inflation and the labor market and commodities and climate change. Can't get much more in than that. Thank you so much to Peter Krause of Aperture Investments and also to Nancy Davis of Quadratic Capital, where she is CIO and founder. Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Wall Street Week. I'm David Weston. It is time now to look at the week ahead on Global Wall Street.
David, we have 3 central bank meetings in Asia next week, and we're watching to see if the RBNZ will hike after holding rates in August, as officials have pushed back on aggressive tightening bets from New Zealand. Now, in Australia, the RBA's stance on surging home prices will be closely watched, along with the recovery outlook as the Morrison administration pushes to reopen with plans to resume international travel. And in India, where the recovery is losing steam, the RBI is expected to stay accommodative, but more liquidity withdrawals are anticipated. And while Chinese markets are closed for the Golden Week break, Evergrande developments stay front and center. Danny?
Thanks, Sophie. The focus is really squarely with the energy crisis in both Europe and the UK and those sky-high prices and any response from policymakers we might see this week. Also, later in the week on Thursday, we get notes and minutes from the ECB's last meeting. Romain?
Thanks, Danny. Non-farm payrolls data due next Friday may shed light on the tightening path of monetary policy as Fed officials wait for labor market conditions to reach levels consistent with maximum employment. Remember, hiring downshifted abruptly in August with the smallest jobs gain in 7 months. Elsewhere, Tesla is holding its annual shareholder meeting. Proxy advisory firm ISS recommending investors reject the re-election of Tesla board members James Murdoch and Kimball Musk. And top airline executives from around the world will assemble in Boston for their first face-to-face gathering in more than 2 years. The International Air Transport Association meeting will focus heavily on the long-anticipated and so far elusive rebound in corporate travel. David?
Thanks to Sophie, Danny, and Romain. Coming up, the massive problems surrounding Chinese real estate giant Evergrande still aren't resolved, with no clear path ahead. But does the Evergrande story raise larger questions about the Chinese real estate sector and for the continued ability of China to drive global growth? This is Wall Street Week on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising. Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda, and there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Basic economics is, for all countries, in all time, is that if your debt is in your own currency, you can deal with it.
You can work it out.
You could work it out. We've seen it happen over and over again.
The implosion of Chinese property giant Evergrande brings back the specter of the fall of 2008. That's when one of the largest investment banks in the United States saw the value of its assets plunge, setting off a crisis of confidence that ended up rocking the global financial system. It's called simply a Lehman moment, and one of the few things everyone can agree on is we don't want another one. For now, though, there seems to be no one who sees Evergrande having the impact that Lehman did.
The Lehman moment produced pervasive structural damage through the system that wasn't rectified until the Treasury came across in terms of its borrowing, and then the Fed came across with quantitative easing. But this is not that kind of a shake-up type of thing.
That's the founder of hedge fund Bridgewater Associates, Ray Dalio. Central bankers are echoing that theme. Evergrande's problems may be painful, but they probably won't be global. Here's Fed Chair Jay Powell and Bank of Japan Governor Kuroda.
The Evergrande situation, it seems very particular to China. There's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed.
While we must monitor carefully for a spillover effect on financial markets globally, at this point, I don't see this developing into a global crisis.
But Evergrande doesn't have to be Lehman for it to send dangerous ripples through the Chinese property market and China itself, according to our special contributor Larry Summers of Harvard.
People should be very much on guard here, and I don't think that any of us have full transparency into what's going on in China.
What we do know is how much the Chinese economy depends on real estate. Nearly 29% of its total GDP, much more than it represented in the U.S. economy at the peak before the great financial crisis of 2008. Here's Milken chief economist Bill Lee.
The financial instruments in China are so primitive that people really don't have a way of saving. And so buying property is really one of the most important things that Chinese families do. And right now, what we're seeing with the potential collapse of Evergrande is the question facing policymakers in Beijing is Evergrande systemic? Is it too big to fail?
All of which raises the question of whether President Xi will have to slowly deflate the real estate bubble, and what that could mean for the Chinese economic growth engine the world has come to rely upon. The possible slowdown in China is one thing that investors have to be focused on right now. Another one is what's been going on all week long in Washington. They finally got a refunding of the government done, so they didn't have to shut down Emery Horton up on Capitol Hill. So, Emery, thank you so much for being with us. Give us a sense of where we are right now. I know that President Biden on Friday went up to Capitol Hill